If you're asking yourself what DeFi crypto is, you're already late to the party, like me, but all is not lost. I'm here to get us all up to speed. This is your boy Stevie B, one half of the investment bros from the podcast Money Talk Sundays. Don't forget to hit the like and subscribe button on your way in. The door, please. Thank you. You know, YouTube algorithms, all that mess. Now, if you are down for the marathon challenge, smash that notification bell. Let's make some moolah, fam. This is what we're about to do. Today, I want to talk about DeFi. So what is DeFi? DeFi is decentralized finance. This terminology covers financial services carried out on a blockchain. Simply put, there is no central authority. DeFi involves taking traditional elements of the financial system and replacing the middleman with a smart contract. It is traditional banking services meets blockchain technology. The evolution of technology, right? Now that you know what it is, how does it work? Well, DeFi first needs a decentralized infrastructure to run on. This is where Ethereum comes into play. The Ethereum blockchain is a DIY or do-it-yourself platform for decentralized apps referred to as DApps, decentralized apps. Most DeFi protocols use the Ethereum blockchain, but some have since migrated to competing blockchains to benefit from greater speed and scalability. So, what apps and notable protocols are on DeFi? First off, you have Dexs, which stands for Decentralized Exchanges. They operate without a middleman or an intermediary. Users can use Dexs to connect directly with one another to buy and sell crypto in a trustless environment. Peer-to-peer, Napster, LimeWire, all those other ones. Crypto traded this way are never held in an escrow or third-party wallet like centralized exchanges. Examples of Dexs are Uniswap, Curve, and SushiSwap. Now, the opposite of this is obviously centralized exchanges, and examples of that would be Binance and Coinbase. They are custodial in nature, meaning buyers and sellers of crypto trust the platform to keep their assets safe. Then there are lending platforms. Decentralized lending platforms use smart contracts instead of middlemen, such as banks, letting the borrower and lender operate in an open environment. Lenders can earn interest on the crypto that is lent out, while borrowers can access liquidity without selling off their own assets. Now, the traditional finance system would rather demand collateral before you can access these loans. Not the case with DeFi. Some of the top DeFi lending platforms include Maker, Compound, and Aave. Uniswap is a DeFi protocol built on Ethereum for swapping tokens. Decentralized exchanges solve a multitude of problems that plague centralized exchanges, like security breaches and high fees. But they struggle with liquidity. Uniswap was created to end the issue of liquidity around decentralized exchanges. Now, Uniswap is an automated liquidity protocol that does not require an order book to make trades. It relies on liquidity providers and a decentralized pricing mechanism called the Constant Product Market Maker, which is a variant of the automated market maker that powers yield farming. Now, AMM, automated market makers, are smart contracts that hold the pool set aside by liquidity providers for traders. Now, what are the benefits of DeFi? Well, first off, you could say it's permissionless. Regular banks have hoops to jump through and are bureaucratic to a fault. They take forever to process transactions, and they have blocked many people out of the financial system due to their stringent and ridiculously tight requirements. DeFi, on the other hand, it opens up the financial system to literally anyone and everyone in the world, regardless of income, race, wealth, culture, or geographic location. All a user needs is a mobile device or a PC with an internet connection. Secondly, DeFi boasts competitive interest rates for investors. Platforms like Compound and Aave that I mentioned before let you deposit your assets and lend them out to other borrowers. You receive your interest rate and are able to plow your capital back into the system. For example, Compound offers up to 4.3% interest on deposits from some tokens, while Aave is doling out as much as 5.73%. You're lucky if you can find a bank that'll offer anywhere near that or break 1% on a savings account. Now, DeFi provides you with an unrestrained control over your finances as well. While you do have to deposit your funds into the platform, you decide what happens to them. There are no human intermediaries deciding whether you qualify for a loan or deciding on how to manage your investments. All that is done with smart contracts. You are in complete control. Now, based on all this information that I just gave you, you would think that this revolutionary technology is too good to be true. But before you go dumping all your life savings into DeFi, you do have to consider some of the drawbacks. Number one, there are some security issues with smart contracts. By default, smart contracts are open source. This design allows prospective users to review them before investing in the DeFi protocol. Most DeFi protocols give their smart contracts to security firms to audit. This is where the problem begins. It is not unusual for humans to miss flaws in these contracts, which could be exploited. Yeah, that's my daughter in the background. In the future. Now, take the DAO for example. The Digital Decentralized Autonomous Organization was an investor-directed venture capital fund of sorts that launched back in April 2016. It grew quickly to become the biggest crowdfunding platform, managing about $120 million. However, by June of that same year, hackers found a vulnerability in the smart contract and stole about a third of its funds. They moved the funds into a child DAO, which had the same structure as the parent protocol. Users couldn't access their funds for weeks, making this perhaps the largest hack in crowdfunding history. Now, there have been several refunds since then, allowing investors with residual DAO tokens to get some compensation. However, the incident sparked an awakening in the DeFi space. Now, developers who build protocols ensure that their smart contracts go through multiple, not a single, but multiple audit rounds. Secondly, blockchain protocols can't access off-chain data. So to remedy this, many of them use oracles or third-party services that provide access to external information. Oracles serve as bridges between blockchains and the outside world, relaying information to smart contracts for them to utilize. Now, the major issue with oracles is creating a central point of trust into the trustless and decentralized setups. This centrality provides a vulnerability for the entire smart contract. Now, when an oracle broadcasts the wrong information, the consequences could be dire. For example, take the case of Synthetics, which is a DeFi asset issuance platform. Back on June 25th, 2019, an oracle transmitted false price feed data to the platform's smart contract. A user's trading bot took advantage of this and inflated the user's balance. This allowed the user to convert this balance to about 37 million synthetic tokens, worth $70 million at the time. Synthetics confirmed that they reached out to the user, who agreed to reverse the transaction in exchange for an unspecified bug bounty. Then, third of all, you also had the bad actors to consider. In September, the top crypto exchange, KuCoin, confirmed that it had suffered a hack that saw $150 million in Bitcoin and ERC20 tokens transferred from its hot wallets. Days after the event occurred, blockchain intelligence software Elliptic crunched the numbers and found that the exchange had actually lost about $281 million. The report added that the hackers had been laundering the funds through DeFi protocols, Uniswap, Kyber Network, and others. And as Elliptic explained, many centralized exchanges had frozen the hackers' accounts, preventing them from moving their funds. However, in decentralized exchanges, the hackers found the perfect conduit, perfect platforms with no central authorities to freeze those funds. So with all that being said, where is DeFi headed from here? Well, DeFi's performance in 2020 has put the entire crypto market on notice. With assets locked increasing in value, even some traditional crypto companies are looking to cash in on the hype. According to DeFi Pulse, the total US dollar value locked in DeFi now exceeds $16 billion. This is an increase of more than 2,300% as of December 2020 since the start of the year. Unfortunately, DeFi's boom has attracted a bevy of malicious actors as well, because recent data from crypto analytics firm CipherTrace reported that total losses from DeFi thefts so far in 2020 is $100 million and is quickly rising. In the second half of 2020 alone, 50% of all cryptocurrency thefts were from DeFi protocols. Centralized exchange KuCoin also had about $19 million liquidated by thieves via decentralized exchanges. CipherTrace believes that DeFi's growth made it a prime target for these cyber criminals, most of whom understood some of its technical limitations and could take advantage of them. The DeFi industry faces the same growing pains as the crypto space as a whole. It's still in its infancy with plenty of room for growth. But despite the benefits and returns, it's still a risky endeavor for the average investor. So, some of the top DeFi coins include Uniswap, Maker, Cake, AAVE, and YFI, which stands for Yearn.Finance. I could go on forever about these coins, but the introduction has been made. Do your research, learn more about the DeFi currency. I would advise, although I'm not a financial advisor and this is not financial advice, stashing some money aside into these coins. That is all I'm going to say. Thank you all for tuning in. If you found any of this information helpful and insightful or inspiring, hit that like and subscribe button, comment, get involved. This is Stevie B signing off from Money Talk Sundays, and as always, RIP Nipsey Hussle. The marathon continues. Let's make this week a profitable one. Let's get this moolah, baby!